Yeah, Jedi options. Let me pull up some of my tools here. Listen, Matt's speedy today. All right, holiday week. We're shortening this
Efficient.
bad boy.
It's called efficiency.
It is efficient. Watch me be not efficient with his Jedi options. I might go 30 minutes just because I've got.
Listen, I'm being efficient today because I lost my voice on Monday and I'm trying to recover it. If you want to go 30 minutes today, I think that's amazing.
Listen, just buckle up, boys and girls. All right. So let me set the stage here. I've got the title of today's Jedi options segment is the Fade the Fear trade. So every system that you build, that you personalize, that you customize, you should come up with a clever little name just to differentiate it, right? So we're going to call this the Fade the Fear system. And I initially introduced this in the Bear Market Survival Guide, actually. Bear Market Survival Guide. When the market crashes, when you get bear markets, volatility goes pretty high, and you tend to see this type of setup quite often, right? Recently, in a bull market, things have been hunky-dory, things have been bullish. We haven't seen as many sell-offs. We haven't seen as many spikes in volatility. So you haven't seen this pattern as much, but you are seeing it show up right now. So consider this a shortened, condensed version of this particular system. There are technical criteria. There are volatility characteristics, and then there's how do you want to go about trading, right? So the trade setup here, is I need an oversold market and I need a high implied volatility. So like a volatility spike. So when you think about the terms here, fade the fear, why is this descriptive? If you fade something, you bet against it. Okay. You're a contrarian, right? Fear, we're defining as, well, how does fear manifest itself in the stock market? Usually it crops up when you get a big sell-off. But specifically in the options market, it causes people to run out and buy insurance because they're freaking out. And it jacks up the price of put options, right? So you get a big sell-off plus an implied volatility spike. And we've talked about implied volatility on Jedi options before, but essentially it is the reflection of whether options are cheap or expensive. When you get a spike in IV, it tells you options are expensive, which can be an opportunity if you're willing to sell those, right? So the bet here is I'm betting the fear is overblown and the market won't sell off as much as is being priced in. Okay. And it's almost like, look, I don't do this every time we get one down day and a little bit of fear. Like ideally, it's gotten excessive. It's like, look, guys, I understand there's a little bit of fear out there, but you're losing your minds and you've gone a little too far. The rubber band is stretched too far, and I'm willing to step up and do something bullish in the face of this fear. Okay. So that's a little bit of the background on the name. Now, here's a couple of tips, and we're going to do this on the Russell 2000 index. I really like this best on ETFs or indexes because there's less of a chance that they completely implode. As we've been reminded on some of these individual names we've looked at, particularly like the stay-at-home names, the high beta growth names like Zoom, like Zillow, like Teladoc, like PayPal, Twitter, even recently Snap, like some of these have just gotten completely dismantled. And trying to pick a bottom in those can be very, very tricky and just irresponsible. But when it's an index that tends to be a little bit more mean reverting, I think that you have better odds with this type of play. So IWM in particular, and you can look at RUT or IWM, it's the same story. But from a price perspective, are we oversold? Well, look, this is the most oversold index of all of them. The Dow is not this oversold. The NASDAQ is not this oversold. The S&P is not this oversold. And that's what we were referencing earlier, where it's like, look, you look at the S&P and it's like, what's all the fuss about? Nothing's happening here. We're just going sideways. It's like, well, yeah, that's the wrong index to look at. Go look at ARC. ARC is getting destroyed. High growth, high beta names whacked over the last couple of weeks. Small caps destroyed. And I'm being a little bit, a little bit of hyperbole there, but on a relative basis, yeah, these have been dismantled. I think from peak to trough, we're down maybe 7%, right? But look, we're at the 50 MA. We're at old resistance, new support. To the point that I mentioned earlier to Matt, you want to go bearish right here after having gone down this much? Forget it. Forget it. So it gives me confidence to fade the fear on a morning like this morning in light of how oversold a bunch of other areas are. As I went through all those ARC names and some of these other small caps, they're grossly oversold. It's like, look, even if you're bearish, you want to bounce. Bears want to bounce to give them a better entry point. Bulls want to bounce because we're so oversold. So that's the technical posture. I think you can make a compelling case. And then what about the volatility characteristics? Well, we talked about this last night in the coaches show. If you take a look at the VIX and you add a Bollinger Band, Bollinger Bands are a good little indicator to use if you want to identify when something is overbought or oversold, or when it's at an extreme. Historically, spikes in the VIX have signaled short-term lows in the market. And you can overlay, let me overlay this with the S&P, because the same principle applies with IWM. So you have the S&P in purple here, and then you have the VIX obviously with candlesticks. But take a look at the visual here, Matt. If you, hang on, I actually want to reset that. Reset my Zoom. Okay, there we go. All right, if you look at some of these right there, look at some of these spikes in the VIX and look at how they corresponded with lows in the market, right? And specifically, how am I defining the spike? Well, a pop above the upper Bollinger Band, right? Pop above the upper Bollinger Band. It's not 100%. But dude, it's close.
It's close.
It's close.
It's actually very impressive data.
It's impressive. And so it's like, well, what happened here? You got a spike above the upper Bollinger Band in the VIX. Now, the curious thing is the S&P really didn't sell off that much, but IWM did. So if I just said, you know what, let's switch the comparison and let's compare it to IWM, which is the Russell 2000 index, because we know that got hit pretty hard. If you do that, same analysis, I'm telling you, it's pretty consistent. And then it makes this current one look a little bit more on point, right? It's like, look, we don't have to do anything here, but the odds suggest maybe a bounce is due. And so from a timing perspective, I think the VIX spike helps, but it also helps tell you what types of strategies are appealing. Options just got more expensive. And so what that does is it inflates how much you can make on short puts or bull puts, right? And so I'm licking my chops this morning. And by the way, this was a discussion in Discord in my trading lab. Go look at the stream. All this morning, we were talking about this idea of fading the fear and why today I think was a pretty interesting day to start to entertain this idea because of these characteristics. But you can go pretty far out of the money and sell puts in IWM out to December, out to January as a way of betting that the fear is overblown. Market's not going to sell off as much as is priced in right now. Particularly, like, forget even seasonality. You want to be a big bear in front of December. Tell me how many times historically that's worked. It does every once in a while, but most of the time, it pays to give buyers the benefit of the doubt going into the last month of the year. I think that works to your advantage as well. So how do you structure this? If you get back to the actual, so there's the trade setup. If you look at the trade structure, I'm not a stickler on this. Look, naked puts, bull puts, however you want to structure the thing, where you have a low delta, so you have a high probability. I want a decent ROI. Whether you scale in or do it all at once, we tend to scale in my trading lab. But we were looking at this earlier today, Matt, and December's getting a little bit tricky just because we're within 3 weeks now. So if you go to January, what were we looking at? We were looking at a 203 put. This was trading around $2.15 this morning. And you look at 203, and I know people don't like selling naked puts of something this expensive, but you can modify it to a bull put. But it's like, look, what would it take for us to get down to 203? Like, not only would this breakout have to fail, you would essentially have to see the inverse. Like, think of all the optimism and excitement you saw with the breakout to the upside. You would have to see an equal and opposite amount of pessimism and bearishness for this thing to get to 203. I mean,
well, Ty, I think about the amount of things that would have to happen for the Russell 2000 in the next 58 days to get to 200 or 203. The entire market would have to fail. The entire marketplace would have to fail. And then you would have to have an entire world market also fail. And you would have to violate literally more support levels than I have to. I would get back on my normal time frame just detailing all the different support levels that the Russell 2000 would have to break to get to 203.
Right.
It's got a lot of support underneath that. But one thing I love when you're doing credit spreads, one thing I absolutely love is the deeper retracements technically, because I have that same philosophy you do. You're down 7% off the highs. You haven't had a pivot. Is this thing just going to free fall? That's not my read on the Russell 2000. That hasn't been my read in the last 2 weeks during this 7% downward movement in price either. I've got this fading action. I don't have it like a massive increase in volatility with violations of support here. I like the zone you're in.
Yeah. So you throw all that together, and it's like this is a perfect example of a trader just trying to stack the odds in their favor. And it's like, how does this contrast with a coin flip, right? Like, this is so far away from a coin flip in terms of your odds of success. This is exactly what we're trying to accomplish as traders, is put ourselves in positions where, look, we acknowledge we could be wrong. Anything could happen, but you really have to have an active imagination to think that this is going to go down to 203. And by the way, if it does, then it's all about trade management. Then there are ways that you can manage around that. But I love this as a starting point. If you want to tempt me to do something, if you want to try to pitch me a really attractive trade, you do what I just did. And then I'm like, dude, I don't know. I'm convinced. Like, I got no rebuttal here. The only question is the timing. Do you do it today? Is today's green bar enough? Do you wait to take out yesterday's high? How much confirmation do you want to use the 2330 on the Russell futures that we looked at? I don't care. Like, I don't care what you do. All I'm saying is right now, this looks pretty dang attractive. And as far as a fade the fear type of trade goes, this is about as good a setup as you get. I don't know if it'll work, but I'm just telling you that this is the type of setup I want to see. Print it out, stick it on your fridge. When you see this again in the future, I'll act on this every single time.